Hi, can you hear me? Hi, can you hear me? Do you mind making me a panelist, please, so I can share screen and stuff and see who else is here? Great, thank you. Can you hear me?
Yeah, I can hear.
Great. Okay, so just let me know when you want to start then.
Let me start introducing you first, then we will start. Okay.
Okay, great. So I'll wait for your cue. Thank you. Thank you for the
Thank you.
invitation.
Good morning, everyone. Welcome to today's session in our ongoing webinar series, Capital Markets, Digital Transformation, and Sustainable Development. Today, we're honored to explore the topic RegTech and implications on market structure for financial advisors with one of the foremost experts in financial regulation and technology. It's our privilege to introduce Dr. Ben Charoenwong, Associate Professor of Finance at INSEAD, Singapore, and Junior Fellow at the Institute of Law and Finance in Frankfurt. Dr. Charoenwong earned his Ph.D. and MBA from the University of Chicago Booth School of Business and has since built a distinguished career at the intersection of finance, regulation, and innovation. His research spans financial regulation, RegTech, decentralized finance, and market structure with numerous publications in leading academic journals such as the Journal of Financial Economics, Management Science, and Science Advances. Notably, his recent work on RegTech explores how technology-driven compliance is reshaping financial advisory services, operations, and profitability. Dr. Charoenwong is also a co-founder of Chicago Global and has consulted for leading firms like Citadel Investment Group and LA Key Consulting. So please join me in welcoming Dr. Ben Charoenwong as he shares insights into the evolving landscape of RegTech and its transformative role in capital markets.
Great. Thank you so much for the kind introduction, and I hope everyone can hear me okay. It's my pleasure to be here this morning. So thank you for inviting me. As mentioned, most of my work is in the intersection of financial regulation and new technologies. So things related to regulating crypto, stablecoin design, automated compliance, um, tokenization, AI used by financial advisors. So that's kind of been my core research area. But today I'll be focusing more specifically on regulatory technology among financial advisors. Okay, so I assume you can see my screen now. So I'll go for maybe about 40 minutes or so. Please let me know if I'm going too fast. At any time, you can use the Q&A function to send questions along the way. And if it's natural, I'll work it into the discussion. And if it's not natural, I will address them towards the end. Okay. So I'll share these slides as well so it can be circulated. So when we're thinking about what is regulatory technology and how can it be used in the firm, this is I'm showing you a survey from Thomson Reuters, which has their compliance arm, surveyed large firms around the world. We have the global systemically important financial institutions, GSIFIs, as well as other financial institutions. And the thing I want to highlight here is, there's all this focus on reg tech and compliance, and certainly a lot of this was compliance driven, right? To satisfy new rules, there's Basel III, there's more monitoring. Many, country-specific jurisdictions have their own rules, regulations, and enforce timing on when to check certain things, right? And I want to highlight here that a minority of firms use RegTech only for risk and compliance. Okay. Whereas a large fraction of firms actually consider RegTech overall to be quite important for operational management. Okay. So the theme of the talk today is I want to try to make the case, for regulators and practitioners that when we're investing in technology to improve our compliance, we're really improving the information quality inside the firm. Okay. And then when new technology comes, like AI and so on, you'll actually see that the firms that had better existing technology can better leverage the new technology that comes in, right? So there's a data and new technology complementarity. So that'll be the case that I'll try to make. We're going to look at the United States since there's a lot of firms there, and I'll give a bit more background, and we'll discuss why I think this study is informative for other areas, so including Singapore, Thailand, and so on. So I want to add thanks for the kind introduction. My last name is Thai, that's why it looks a little bit long. But I was born in America, so the first name my parents named me just Ben. So what is RegTech? There's been a lot of focus on it now. It's really a technology to improve the way businesses manage regulatory compliance, right? So we're thinking new technologies. We have system upgrades. You can think about setting up SQL data tables inside the firm, right? You might have to hire or train technological experts. When you hire analysts, maybe in addition to knowing finance, you also want them to know Python, right? So when I was still a professor at the National University of Singapore, teaching in the beginning of the Masters in Finance, there was a big push, right, to bring in Python and R programming so that the students know finance as well as some coding. And now teaching that and using that has become much easier, of course, with availability of large language models. Okay. Generally, we're going to focus on financial institutions, although it applies also for hospitals and so on. Financial institutions in particular, because we deal a lot with sensitive information, right? We have a lot of compliance burden. So the applications of RegTech have typically been in regulatory reporting, risk management, thinking about satisfying capital controls a la Basel III, and so on, and consumer protection. I think in 2022, for those of you who are involved in the cryptocurrency market, right, the failure of FTX, where the exchange FTX took clients' assets and just stole from them, right, and traded on their own and lost money, is exactly the classic case of where RegTech should have solved or prevented all of these problems, right? So in fact, there's already rules in the United States on custody, right? And there are many other jurisdictions in the EU and so on as well, right? But what happened is that they would take money out from clients' accounts and then try to put them back towards the end of the reporting, right? And so what happened is that actually the regulations were not being followed at all times. Okay, so that's going to be this theme that I'll be thinking about. Can we get compliance at all times? And later I'll pontificate a bit towards the end of the talk. Can we get regulation compliance ex ante? That is, can I check that you're not going to break the law before it happens, right? Rather than wait for something to happen and have to do some investigative reporting. Okay, so I want to make the case compliance is a big business. If you compare the amounts, there's a lot of focus on auditing, right? Auditing corporates, making sure their financial statements are good. There's a lot of regulations and research and studies surrounding that. But in 2020, RegTech spending is already more than 10 times that, right? In terms of the software and the hiring for getting these talents and skill sets, right? And the capability to ensure compliance. Not only was it already high, but the expenditures are forecasted to grow. So this is the numbers from the United States, 34% per year. That's been on track since 2022. In Singapore, that's growing at slightly more than that due to a large money laundering scandal in 2023 in Singapore. So RegTech spending has gone up dramatically. You have a lot of compliance consultants pop up. There's a lot of kind of tech players now getting into providing these compliance solutions. And as the technology is advancing, and there's also very little sign of major deregulations, right? If anything, we're going to add more regulations typically, right? Rarely do we start to cut regulations down. Although, as a Chicago trained economist, I think you can also make the case for during sometimes it might be good to deregulate. Okay. So this is a quote from Deloitte. So I'll be trying to weave in some industry research in addition to kind of the deep dive that I'm doing on the United States. Deloitte report here says RegTech promises to disrupt the regulatory landscape by providing technologically advanced solutions to ever increasing demands of compliance, right? It's kind of like intelligence, right? Like once the AIs come, we think, wow, it's going to replace workers, but now everyone will need some form of intelligence, right? And so now the best job to have is someone who can use AI very well, right? You can move into many firms and help set up things and so on, right? So similarly, being able to do compliance doesn't like cut work. It actually means you want to keep increasing the capabilities that you have within the firm. Okay. So the setting I'll be focusing on is the United States broker dealer. So I think this is the right place to talk about it. The Mongolian Association of Security Dealers. So we kind of very similar framework here. We'll be talking specifically about custody rules, right? So I'll give the background, and I believe the system should, from my own research prior to this call, should work similarly in Mongolia as well. Certainly, outside of Mongolia as well. So what do we have? There's a flow, right, of funds from households on the left towards firms on the right. Typically, it doesn't go directly from a household to a firm, right? It goes through a broker dealer, right? We go open an account with a broker, online broker, right, in person, part of your bank. It can be some app, some web portal. You can do it by paper. It can be a human, right, gets assigned to you to help you do it. And financial intermediaries are crucial, right, in maintaining trust in the financial system. We have a lot of evidence of this, that if there's a big fraud case nearby, like you lose trust in the entire financial system, right? And so representatives of the financial system, right, that are dealing with households, I think carry a fair amount of burden. And for that reason, we put things like CFA requirements, CFA ethics training, right, various kinds of regulations around that, right, because it's a protected and licensed professional activity. Okay. Among these broker dealers, there are two types. Okay. One is called carrying broker dealers. So they actually hold custody of customer assets. And then the other, the lighter weight, that's like easier to open and scale, are what are called non-carrying broker dealers. They have no custody. They're known in America as introducing broker dealers. So if I'm licensed in Singapore, if I do not have the right to take custody, I can still provide financial advice and help my client, but then I might take my client's assets and park it at HSBC, right, which is one of the world's largest custodians banks. So those are State Street, HSBC, and the likes. Okay. But the advice and the transaction services are practically the same. You can custody stuff with HSBC for 10 basis points or less, right? Whereas I provide the financial advice, which is more value added, bigger margins to the client. So in some sense, the custody component is a commodity business. When I show you some more information about the US, a lot of it is also a legacy business. That is, not every big bank is a carrying broker dealer. All right. So I'll be sharing this from our research. This is joint work with Zach Kowaleski, who is at UT Austin, Alan Kwan, who's at Hong Kong University, who I hope also can join us one of these days for another one of these talks, as well as Andrew Sutherland, who is at MIT. And Andrew and I were classmates at the University of Chicago. Okay, so what do? We're studying part of the Dodd-Frank Act, right, which was this huge overhaul of financial regulation in America, the biggest, about 700 pages, the biggest overhaul since the 1940s. Okay, but we're going to study just one specific part of Dodd-Frank, which is Rule 17A-5. And what it does is it actually imposes more internal controls over capital within the broker dealer, and they want to ensure that that capital is segregated from customer assets, right? This is literally, you're trying to ensure regulation against something like FTX. Why? Because this happened in the past, right? There were large Ponzi schemes, the biggest being Bernie Madoff, right? Taking his clients' money to pay out the previous ones and then run the Ponzi scheme. You're violating the customer asset segregation. You have Alan Stanford, as well as bankruptcies of large broker dealers like MF Global, where they just straight up towards the end, getting desperate, just use clients' money, right, to pay their bills, right, which is illegal. And so these people involved all have to go to jail. right? And the rule is quite interesting because when the rule came, it doesn't really change the requirements, but the big change was actually making sure you follow the rule moment to moment, right? So the term moment to moment compliance actually shows up in the regulation. And so at the beginning, we didn't really understand what that means, right? If I say you're not allowed to murder, I would assume it means you're not allowed to murder at any time, right? Not that, oh, you're not allowed to murder by the end of the month, but during the month, you can do whatever you want. And so we thought this was a very weird rule. And so we started talking to broker dealers, talking to regulators, groups of broker dealers such as yourselves, self-regulated organizations, FINRA, in America, and we're trying to understand what would moment to moment mean. And they all said, oh, that means they must have to install these systems so that if any time a regulator asks them for a compliance report, they're able to answer it, right? So it's viewed as, okay, it's like pushing these companies to invest more in technology, in software. And so what we did was we assembled like 11 data sets. This is a huge data exercise. I got information on how much IT budget a company has, the number of servers that they rent from AWS, Google Cloud, and so on. The types of software that they use: Box, OneDrive, Dropbox, right? These places to store information, SQL, Microsoft Office, things like that. We also have tech-related hiring from job postings, so you can think about LinkedIn job postings or other sources. Inside the job posting, they have a description. Do they say something about, needing to know compliance, specifically compliance technology, RegTech, right? And do you need to know like coding or machine learning or data science or something? We also visit the websites of all of the broker dealers and actually scrape from the websites whether there's certain cookie trackers, right? They call them website technologies, on whether or not they're logging to see who's visiting their website, where are they coming from, right? The idea being companies which have or use those types of technologies probably have a good framework to think about how to use data, right? So really, this is a paper about data, right? And you can't do compliance without having that information structured and readily usable. Okay, so that'll be kind of the punchline of the paper. And then we also have granular employee records of everyone who's registered, customer complaints officially that gets filed to the regulator. And importantly, we have both public and private companies. So those that are publicly listed on the stock exchange, as well as those just held, it could be family firm. Many of these broker dealers are small, right? 10, 20 people, less, or maybe less, 3, 4 people, 2 people. We have a bunch that are just one person shops, right? And the sample covers the vast majority of all assets under management in America, which is now around, I believe, 45 trillion or so, and all the employee records for everyone who was registered. And so, if you're interested to read the paper in more detail and kind of go through the concepts and theory, you can scan the QR code here. And again, I'll circulate all the slides as well. And so let me describe the rule change, because I think it really took the regulators some stance to say, look, we're going to push companies to improve their compliance, right? And then the market responds. Because without this rule change, the companies themselves don't have that much incentive to actually buy that technology, because this stuff is fairly costly. Okay. So before the amendment, many broker dealers used systems and technology that were built in-house many, many years ago. And of course, many of these companies go through mergers and acquisitions, and the data is not properly organized or harmonized. The systems and reports may not have undergone periodic testing, and as a result, broker dealers have found it difficult to provide logic details and report parameters to their auditors for testing. That is, by the time the audit comes, if you have multiple branches, the data may be spread out somewhere in papers, somewhere in a document, somewhere in a database. They can't be assembled. So even though they're not trying to misbehave, right? They're not trying to commit crimes. The fact that the data is very disorganized makes it very difficult for auditors and also themselves to use that data efficiently. right? So when I talk to broker dealers now, they ask me, how can I use AI? Actually, most, I think, are not even at the AI stage. Most are at the digitization stage, right? A lot of the data first needs to be harmonized and put together before you can do AI on anything, right? And of course, now the AI can help with structuring and cleaning the data as well. Okay. After the amendment, broker dealers began to invest in shoring up technology or data architecture to alleviate data related concerns, including rationalizing data sources, centralizing data into a single source, and therefore also increasing accuracy and completeness of source data, right? So it doesn't go as far as data standardization, right? But it does actually um, push broker dealers to say, well, we don't have the capability to manage the database. Let's go use different service providers to help us. All right. And so you assemble your suite of providers. They help to do the monitoring and so on. I'll give you a couple screenshots to show some examples. So a big part of this rule effectively started a new industry called regulatory technology. Many are consultant types that worked at Bain, McKinsey, BCG, who realize, right, Deloitte, EY, who realize many companies have this problem, right? So I think it's quite interesting because the founders of Plaid and Stripe, right, they were people from consulting who, after they consult for banks and broker dealers, realized there's a big gap in the market, right, for this type of software. So they came in to fill that. And I think we're going to start to see something like that across the world as well. So it's gone quite mature in the US, but I think outside there's still a lot of gaps, partly because the markets are smaller, right? And so you don't have maybe as many startups that can scale. Okay, so what we're looking at is what we call in academia a quasi experiment, right? We can't really run a full experiment to say, hey, you have to follow the rule, you don't follow the rule. So we use the language of the rule, actually study around the boundaries. Okay, so the empirical specification here, left-hand side, this Y, I'll be studying things like hiring, software use, website investments, tech and compliance, labor demand, customer complaints. Later, I'll also talk a bit about M&A and the structure of the financial market, right? And the main coefficient I'm interested in actually is this post times treated. That is, after the rule came, I'm going to compare those who are affected with those who are not affected. Okay. And then I'll try to control for a bunch of other stuff to make sure that, what we're studying is pretty clean. So I'll just go straight to the punchline. So there were some groups of companies that were treated, meaning they are carrying brokers, they have custody over client assets, and then a bunch of companies that are not treated, right? They were not subject to this moment-to-moment compliance. Again, the rule was brought in response to these Ponzi schemes and these scams, okay? And so they wanted to make sure firms, brokers, security dealers do not commingle customers' assets together with the firm's assets, right? That they're always segregated with moment-to-moment compliance. Okay, so what do we see? We see a very big jump in the adoption of ERP. ERP software is enterprise resource planning. You can think about this as accounting software. SAP, right? We're tracking funds. Okay, so really that's the point of these software, right? And so we see a 16 percentage point increase in the adoption rate. Okay, in terms of the number of servers, so this is done is in a different specification, 0.19, you can interpret approximately 20% increase in the use of servers, right? More compute, more processing of data, about a 10% increase in RegTech related jobs, right? So there's a key component here being that to do it well, you need people who are able to implement and use this software, this new technology, right? So RegTech specific jobs rise, and then tech-based RegTech jobs specifically. So not just can you do compliance and auditing, but can you use software, right? Do you know how to code and you can do the compliance? And you can see here the overall compliance rises a little bit, but not as much. So I'll show you all these results in tables going forward, so it's easier to see. But you could see here the effect on the adopting the enterprise resource planning is a very big effect, right? It was at 0 before the rule change. The rule change comes 2013 to 2014. You can see then it just stays there. Same with the number of servers, RegTech jobs, tech-based RegTech job specifically. What do we see in terms of profitability? So this comes, the real implication, right? The profitability of large firms is pretty much flat. However, the profitability of small broker-dealers falls. It falls by about 14 to 20%, right? It kind of drifts down. And where does the profitability go? Like, why did it fall? Well, it went to the IT budget, right? So we see the IT budget rose by about 24%. Right. So the money that they were going to pay out, right? They're making losses now because they have to spend more. Okay. So how much is the spending? I'll show you a couple more pieces of survey evidence in a bit. But the order of magnitude here is something like $1 million US a year in tech spending. So that's not small, right? And that's to implement. The average size of these firms have about 200 to 1,000 employees. So they're already fairly large. But here's the more interesting thing to me, and then to, I think, academics and other people who are interested in the overall market structure. Okay. So compliance comes, it says you have to do moment-to-moment compliance, and then unsurprisingly, you then do more compliance, right? So we kind of check that first direct effect. But then what we noticed is the moment that these companies invest in compliance technology, they also invest in other stuff, customer relationship management. So what I'm showing you here is a screenshot from a service provider that actually links to the ERP system. So you come in, you say, I'll help you track your customers' assets, right? But as part of that, I'll also give you more information on customer intelligence. So this is a dashboard that relationship managers can see. You can see here what's their name, the email, phone number, right? Details, their activities, sharing their insight, their audit trail, right? That's the main compliance component. You have their assets, people in their household. You have a Monte Carlo simulation on the probability that they're going to satisfy their financial plan, right? And you can see here, you have your customer profile, right? Service level management. Is it proactive, right? Unscheduled? Do you have a scheduled financial review, right? Also notes, who talked to them? What did they see, right? So this falls under CRM, customer relationship management, which I'm sure many of your firms that have meaningful clients, meaningful number of clients especially, have some kind of software like this. But the important piece is this type of software gets connected to the compliance bit, right? So when I see this guy has $4.2 million in assets under management, I also know, right, that 4.2 is sitting in which account, right? So that's part of the audit trail. So the idea here is that without that underlying data of the assets and so on, the reporting stuff is in some sense irrelevant, right? What is there to report if you don't have the data already set up, right? So trying to just improve your own infrastructure or your portal may be negative NPV. But now if you say like, look, you need to do this compliance component anyways, why don't you just add on, right, another feature? Suddenly the marginal cost actually falls, right? Because before I might have thought, wow, the marginal cost to implement this is 1.5 million. But if I tell you, you have to do 1 million anyways for your compliance, right? You might now think, okay, well, then I just top up another 500,000, right? To then just get this additional feature, right? And the key idea here is that the data and the software, the IT systems, are non-rivalrous. That means once I create the data for compliance use, it can be used in marketing, it can be used in investment management as well. So, when mentioned at the beginning, I co-founded this company, Chicago Global. We realized actually we ended up helping to build some of this stuff. Okay, not the whole infrastructure, but the front-end analytics, the intelligence layer for companies that actually already have pretty good internal data, right? But they don't really know yet how to use it. Okay. So what does that look like? We see, investments in complementary technologies, communications management, track, right? So you don't want to do business on WhatsApp. You want to do it on like a platform where you can track what your representatives are talking about. This helps you ensure monitoring. So make sure your representatives are behaving properly according to the law and ethics, right? And make sure there's no disrupted information. So if someone else goes to talk to the client, they also know like what were the previous meetings and so on. Okay. And we see here investments in communications management increased by about 3%. Website, customer relationship management trackers increased by about 10. Premium website features cookies, right? Tracing you. Like when you visited my website, what else did you look at? Right? Did you search this stuff so that by the time you arrive at my website, I have some information. This type of client is actually seems interested in these kinds of topics, right? So that helps with the client servicing. And as a placebo, we see no effect on other types of investments, right? So it seems to be only stuff related to customer servicing, right? Using some of that data that you already have to better communicate and service your clients. Okay. And so we think this is something like a bundling of different software offerings and features, right? The moment you have some data, it's easy then to come in and process it, right? You can't process without the data. And we have stronger results for those who had adopted more RegTech. So it's pretty much all driven by the RegTech component. And so this is kind of how it looks in figures. What does that mean for client servicing? So I'm showing you here some example customer complaints. And those of you in the industry obviously know, right? These are the pretty representative around the world. So when I went to teach at a private bank in Thailand, similar complaints. They were sharing with me similar complaints that customers had. And of course, you want to have a system that can log it, right? So you can track and potentially improve or, fire representatives who are not that good. And so here is an example. The client alleges that the rep did not properly inform her of the market risk involved in variable annuities and mutual funds, right? Or customer alleges the advisor misrepresented the features of a variable annuity purchased, or allegations are unauthorized trading, breach of fiduciary duty, churning, and negligence. Okay. And our secret agreement, right? Rep entered with the manager to forward him all the commissions from the bond trading, which netted about 1.1 million. The commission and resulting material conflict of interest was not disclosed, right? So if it's things related to unauthorized access, no disclosure or no proper sharing of information, if you have a communication management software, you can trace everything back to say, hey, we did send you this and you acknowledged it, right? And so it actually helps the firm, protect and also increase the quality of the financial advice. And certainly that's what we see. So around the Dodd-Frank Act, we actually see customer complaints, misconduct, and big complaints affiliated with $5,000 or more of losses decreased by about 4%. So to put this in perspective, overall probability of complaint is something like 15%. So 4% is actually fairly large. And these are among large firms, right? And well, I'll skip this slide, which is a little bit maybe too academic and technical. Where do the complaints decline the most? It's driven by people dealing with retail. So this is exactly where you would expect it to happen. It's not your private bank, right? Your private bank and ultra high net worth, you can just reach out to your RM, right? The RM takes good care of the client. But in the retail space, right? In the retail space, you have so many clients, right? So it's very hard for one person to handle 10,000 clients. And so maybe the service quality starts to fall and is not as scalable, right? So a punchline for this is the software piece is scalable, right? Almost arbitrarily scalable, right? Compute is becoming so incredibly cheap, right? That if you can leverage that technology to help clients, the ones who benefit the most are typically the poorer clients, smaller clients, more disadvantaged clients, right? So in terms of regulators and policymakers who care a lot about protecting retail, right, and increasing market access, I think this is a first order concern. Okay. And in fact, the effects are driven by firms that did not have a very strong compliance culture already. So companies that have already chief compliance officers before the rule change didn't see any effect. Okay, so let's do a bit of math here. How much do complaints declines actually help the firms? Just from the complaints, okay, not from the improved servicing on other dimensions. Maybe you can get more clients. I don't have data on that. And so the answer is it depends on the firm, right? So in the US, the median firm, 50th percentile, the damages from complaints is about 800,000 per year. Okay, for broker dealers, for the median, right? So if you reduce complaints reduction in damages by about 10%. That's about 80,000, right? The IT budget data that we have is actually about 2.8 million. And so the compliance burden increase is around 1.2 million increase in costs, but the benefit from reducing the average complaint amount is about 80,000. So you can see here the cost is bigger than the complaint reduction, right? And this is why without the rule, firms don't find it meaningful to invest in it themselves. Okay. But again, we don't measure the other benefits, right, that the compliance technology actually brings. Okay. And so you can see here, firms have incentives to invest in value maximizing level of controls. So if doing a good job is very expensive, then let's not do it, right? We just have more complaints. That's fine. All right. And so, strategy driven tech investments, for example, at hospitals bring in economic benefits, but regulation driven tech investments do not. It doesn't mean it doesn't have any benefits, but overall, on net, right, it's going to impose more cost onto the firms. That's why it's a policymaker decision whether or not, they want to push the companies to do better regulation. So in Singapore, after the big money laundering scandal in 2023, the biggest in Singapore history, they tightened up regulation even more, right? So that's a stance the policymaker is taking. Okay, so here's the consequences of the tech adoption. Um, you have a bunch of fixed costs. It's actually easier than for big companies, right? Bigger companies tend to win. They have bigger scale. They're investing in data is more worth it for them. So the last piece of evidence I'll show is actually M&A. So what happens is now compliance costs rise. Small firms start to sell or join bigger firms. So you actually get larger firms emerging, right? So because they can share the fixed cost of the technology. Okay. Now, interestingly, we also see good advisors move to the bigger companies that have better data, right? Because it actually helps them to service. And maybe when you do better service, you can bring in more clients, you have better pay, the company gets more profits and more revenues, right? Profits decrease in the short term, but maybe in the long term it can rise. But we don't have data on that yet. Okay. And so as a consequence in the market, what I'm showing you here on the left is actually a rise in the HHI, which is a concentration index. So what that means is the market becomes more concentrated among the big firms, right? And among those that had no rule change, there's no change in their HHI. Okay. And so what does that mean, for regulators, for practitioners, for academics? So we find evidence that the regulation compelled both direct and indirect tech adoption. It leads to fewer complaints. That seems like a good thing, but profit declines, and it declines much more for smaller firms that got affected by the rule, right? As a consequence, they sell themselves, they merge with others, right? There's been this rise, especially in Europe, of roll-up private equity funds that buy a bunch of independent financial advisors, group them, install software, they do better, they're bigger and more profitable, right? And then they sell the company. Okay. So what that means is the RegTech strengthens the link between compliance and non-compliant functions within a company. There's a role of technology and investor protection, but when these costs are fixed, right? Whereas the benefits scale with size, it tends to then favor large firms, right? So in a market where you have a bunch of small players, they may not have as much incentive, right? But someone may come in and say, all right, let's then join a bunch of these small firms together. Then it suddenly may be worth installing these things. So for developing markets, I think what the US experience tells us is that it leads to fewer complaints, reduced misconduct. Overall financial advice can increase, but there's some implication in market concentration, right? There is this notion like big firms win more, right? At the consequence of smaller firms. And so, for Mongolia, when you're thinking about RegTech design, and this is based on my experience talking to Thailand, Malaysia, Indonesia, when we're trying to design policy, you want to still protect the smaller institutions, right, and allow competition. In Mongolia, it's dominated by SMEs, right? Similar to most countries, actually. That becomes crucial that you're not punishing the small firms, right? And so proactive approaches can prevent some of the concentration effects. And that may include, here's an example from Singapore. Singapore actually provides a RegTech grant where if you're a financial institution, particularly a small one that wants to test new technology, the government actually bears, I believe, up to 70% of the cost. So for the fund that I work with, the investment manager that I work with called Chicago Global, we also benefited from this grant as a small manager. Okay. And so the model, maybe, here's Singapore's version just for some information. You have a testing environment for RegTech innovations. There's a sandbox, right? So I actually was an advisor to some companies trying to help with the regulatory technology, right? And they can get some money, some VC funding, angel funding, test it out. They have a testing framework for big companies to try the new technology, right? And if it seems to work, they want to scale it. The government may also come in and also help provide some support or some incentive. Okay. So you see here, financial grants up to 500,000 for first movers. You have streamlined applications. There's also these events like investor networking. So most recently, Monetary Authority of Singapore, which is the regulator here, also brought in an AI consortium, which now I am a part of as well, where they're trying to have practitioners in financial institutions share more information about what kind of AI deployments work, what pipelines work, right? Give research talks a little bit like this, but focusing on application and use of AI. And so in Singapore, RegTech market is growing like 26%. It's around 200 million now. It will seem to keep continuing for a while. Okay. So, maybe we could think about the issue is regulation can be jurisdiction specific, right? So if you're like Thailand, that market is not huge, you might want a local player to come. There might be scope for a local player to come and just help and dominate that market, right? As opposed to a RegTech from the US coming in. So they're going to have a very big trouble because the rules are so different, right? And then maybe it's worth thinking about once these solutions come, right? Anything that looks promising, you want to provide targeted support, right, to build that RegTech development, right? If not, there's no one to push this, right? In the US, it's a big market. When the Securities Exchange Commission just comes and punishes a bunch of firms, the firms already respond, right, by investing and creating this RegTech market itself. For smaller markets, there may be no force to push that, right? So if there's no push, then maybe it just never gets adopted. And what happens is then you continue to have kind of, non-tech enabled solutions in that particular market. Okay. And I think there's also space for regional partnerships, of course, to kind of harmonize certain solutions, use similar procedures, data pipeline, even respecting data governance and so on. Okay. Of course, the way to implement it nowadays is cloud-based, right? Most useful for SMEs. Cloud is super cheap for certain things. For compute, actually not that cheap. And so, working with cloud providers, looking at something like RegTech as a service makes things lightweight, right? So people can try and test it, implement, and get access to this dashboard. There might also be shared infrastructure models. Some markets have tried to do this, right? Austria has All-Rep, right? They have a central platform between banks and central bank. So, maybe something about some reporting utility or standardization of templates. In Singapore, there's also something called Cosmic, which is now, pushing banks to share certain, not all, right, certain information with each other to better flag and find money laundering, right, and fraud and so on. I think there's a lot to do on the high impact, low cost, right? A lot of the time, like it's the initial investment that gets you the most results. And then later on, if you push it even more, it gets a bit better, but not a huge jump. Priority areas is, of course, AML KYC, right? I think decentralized identity management, there's a scope for that there. India was extremely successful with what was called the India Stack, right, which implemented Aadhaar, which puts your ID on a government, kind of a GovTech app, right? Singapore has something similar called SingPass, where if I want to open a bank account, I can just connect my SingPass and it gets information directly from government servers, and I can open a bank account in maybe 2 minutes. Okay? I mean, it's really amazing. So. And of course, once you can easily tie identity to bank ownership, you can then have real-time transaction monitoring. So that was the idea of Cosmic and All-Rep. And also mandatory regulatory reporting. That actually ended up allowing broker-dealers, companies in Singapore to move way more money, right? Because a lot of this compliance checks can be done automated. And so we can move up to $1 million a day with instant settlement, which I think is fairly impressive. So no delay at all. I can pay it and then you'll get it in 2 seconds. Protecting SMEs, right? We want to think about proportional regulations based on size. So in the US, you have this. If you're a big bank over some size, you have these burden. If not, you have some other burden, right? Something about sharing infrastructure makes a lot of sense, particularly data templates, standardization templates, right? That everyone can benefit from. And then, of course, government subsidies, right? That's kind of been the main way to entice more RegTech adoption, to improve compliance and improve service quality and so on. Market structure, we talk a bit about it already. And so I guess at the end, we're going to think about, what happens to the financial sector? How can we reduce compliance costs overall? This game of compliance has returns to scale, right? So that means it's hard to start at the beginning, but once it's already at some level, it's easier to then give it to a bunch of other people at pretty low cost. Okay, so for this reason, I'm like fairly excited in this angle of financial technology. Okay, I was also asked in the last maybe couple minutes to talk a bit about INSEAD as an institution, in case some of you may be interested to take classes with me or people who are much better than me at teaching, and cover various other dimensions like leadership, public speaking, crafting your career, right? Not just finance. So I'm in the finance department. Who are we at INSEAD? INSEAD actually the pioneer in executive education. That's the bread and butter. So we incorporate AI in our teaching. So I'm writing an AI-based case that actually allows people to interact with a financial advisor and detect whether or not there's a misconduct. Of course, I don't really have to show this, but we've been ranked #1 for executive custom programs for many years. Our faculty are very strong. We have campuses in Singapore, in France, in Abu Dhabi, and a center in San Francisco. So depending on the client, so if there's a group of you that are interested, I can put you in touch with the team who will craft exactly what you need. So it could be 2 days in Singapore, 4 days in France, and then visit the ECB, right, to see how do they do regulation there, and then go to San Francisco for a couple of days to also see how AI is being implemented in the financial markets, right? And so I think it's a great as well as Abu Dhabi. So I think it's a great coverage of kind of the leading areas around the world. So I used to be at NUS, and part of why I moved to INSEAD was this access to the world. It's a lot of flying because I teach both in Singapore and in France, but I think it does open your eyes a lot to like what is possible and what's being done. Okay, so I'll skip this last bit. And yeah, so we've been in Asia for a long time, since the year 2000. So maybe I'll just kind of end the talk here and then open up the floor for questions or comments. So you can use the Q&A.
Great questions. Okay, if
Okay, so there's a question. Mongolia is currently looking into adopting RegTech for the capital market. How does FINRA reporting filing systems compared with modern RegTech solutions in terms of compliance, automation, and relevance for developing markets? Okay, that's a great question. So I used to work at a company called Citadel Investment Group. At that time, actually, Citadel Securities. So the connections of trading into FINRA were automated. So it's all API based. End of the day, you push all the trades that FINRA requires you to report and the flags, you push them to their central repository, right? So that's on the trading side. So they had APIs that were open to member institutions, regulated institutions. In terms of the regulatory filing system, that is, and the compliance at the person level, customer complaints, stuff like that, all of that lives actually on FINRA's database. And that actually makes research like this, like for people like me, right? It enables research like that. So we can track where people are. You know, most markets have this, right? Singapore has this system where you can go pull up registered representatives. The data is not as open. I cannot just pull the universe of who's registered and check. I have to go one by one. And I'm not so happy about that feature. They seem to do it on purpose. But yeah, so I think making the data available is the first step, because if you look, a lot of the compliance issues is like people pretending to be financial advisors, right? And like scamming you, right? So the first thing you typically do as an investor, and we teach this in classes, when you talk to someone and they're providing financial advice to you, first thing, go check the platform to see if they're actually registered, right? Whether they've taken the tests, whether they've passed the ethics, what level of qualification do they have, right? The problem with investments is it's pretty low signal to noise, right? And so, someone can invest in Bitcoin, do very well, and tell you, you should sell your house and put it in Bitcoin. Yeah, it's worth checking. Like, does this person actually have the right background? And did they take your consideration into account? And are they required to act in your best interest, right? Which actually, in many markets, they're not, including Singapore, right? Which actually misconduct in Singapore, my guess is actually much higher than in the US. And the problem is they don't make that data public, right? So when I was a PhD student at Chicago, um, my advisors was the first to actually get that data and summarize it and then make it public. Here's the good firms, here's the bad firms, these are kind of the correlations. And that was covered by the New York Times. The regulators started focusing more, right? I think you need studies like that, right, to kind of understand and push the industry forward. Okay. Um, does the increased reliance in RegTech unintentionally create new systemic risk over dependence on shared infrastructure? Yeah, and correlated errors, maybe from the AI or other machine learning. I think absolutely. In the US, there's a lot of focus on this, especially on the discrimination component, right? That if my name is like super similar to others, I get flagged even though I did nothing wrong, right? And so if everyone uses the same system, right, then I can all get rejected even if I didn't do anything wrong. So there's a trade-off between type 1 and type 2 error. And so I still think there's definitely scope still for people, right? So you have maybe the AI do 80, 95% of it, and the hard cases then will fall back to people who do the deep dive, right? If you think about it, the vast majority of people are not trying to commit AML, KYC, right? They're not trying to commit crimes, right? To launder money and fraud and so on. It's really about catching the bad apples, right? And the bad apples are not stupid, right? And so once you say, here's the rule, this is what we're going to do, they'll find ways to get around that, right? And that's really also the issue with the money laundering scandal in Singapore in 2023, right? They were using Chinese nationals with the non-Chinese passport, right? And so now if you're a Chinese person, I'm born in China, but I show up with a passport from Colombia, Portugal, or Vanuatu, right? I get flagged, right? So it takes me some time. So what does that do? It then creates some discrimination for actual Chinese people who are from Vanuatu, right? And so that makes that pocket of the population more difficult to open bank accounts. That's a trade-off I think the regulator needs to take, right? And the banks need to take. And so I think there's a lot of scope for the RegTech stuff, but there's also some frontier things, right? Like preemptive screening, automated AML, KYC. Like there, I think the kind of inequality, it needs to be balanced with market access. In some sense, is it in order to find the 120 bad actors in Singapore, should I have increased costs for 6 million people, right, to find those 120? That's a stance I think the regulator needs to take. Or are there other low-hanging fruit things, right? For example, my average balance is, 1,000, but suddenly I'm doing 10 million of inflows and outflows, right? There, you might just have a behavioral flag that might work instead. So I would say that, you can kind of get a long way there without much. But the first step is getting that data in the first place. So I think certainly if compliance goes towards large language models and AI, then those areas are going to be increasingly important. So when I talk about RegTech, and the machine learning, it's not really the LLM space, right? It's like random forest. It's like stuff that's a little more explainable. Okay, next question. Does the organizer conduct market assessment or country diagnostic to identify what a developing market like Mongolia needs and how to address those needs strategically? Interested in exploring how such insights can guide technical assistance from donor organizations operating in Mongolia? That's a great question. So I think, first you need to know what the problems are. Typically, how that's done is via like an industry report. So you might hire a consulting firm, right, like McKinsey, Bain, BCG, or mid market. If they're too expensive, you'll come down to Deloitte, EY. They're very good with that stuff as well. They may or may not then reach out to people like me, right, to come in, run some surveys, and then help write a report. So these are typically commission reports. From my own interest, because I am ethnically Thai, I do a lot of work in Thailand for free just because I care about the country. I similarly for Mongolia, I have some Mongolian friends, like trying to build out that market. It would require a bit of financial support to run experiments and diagnostics, but that could be an area to collaborate either with academia, right? Like professors, universities like myself. All right. Or, if you want a very tailored proposed solution, then I think you would talk to the consulting firms, right? Generally, that's what they're pretty good at. Yeah. Thanks for that question. I think it's very, very practical. But yeah, the first step is like to benchmark where is Mongolia relative to all the other markets, right? And what are the kind of low-hanging fruit areas? So if you're interested to work on, to commission a report like that, you can reach out and I can see if I can introduce you or if I have time and capacity to also work on that.
Thank you so much, Ben. Yeah, we need that assessment, and then it's the kind of low-hanging fruit that first, the developing market like Mongolia, we need this kind of RegTech and infrastructure challenges as well. So
Right.
if our organization ever get any technical assistance, we're going to reach out to you, welcome you as a consultant.
To me, this kind of thing I think can have a lot of impact, right? And so, you're right, identifying the low-hanging fruit parts. Um, yeah. So like in Thailand, it was people didn't know how well funds were performing, right? And Morningstar data for those Thai funds were not that good. So I came in and helped build like a benchmark database, right? So now it's easy to do some of that analysis, right? It's like what we teach, if you send people to Harvard, they teach you this, but then you come back and you say, wait, but the data's not even here. We have to start there, right? Assembling all of these things. And that just takes, willpower, right? And some resources.
Thank you. It
Great.
actually
So
was very insightful.
great. So yeah, thank you everyone for joining. I know we're a couple minutes over. And so if you're interested in INSEAD, please reach out. I'll share some contact information for people who specialize in, crafting it kind of exactly what you need. So if you say, here's my pain point, we feel like these are industry leaders, but they want to think about how to implement these systems. Like we have programs designed specifically for that. And experts in bringing that to the market, right? So I'm not an expert in implementing and scaling that technology, right? In terms of technology management. So we have people who do that.
Hey, I'd like to extend our sincere thanks to Dr. Ben Charoenwong for his presentation. Uh, so your expertise and clarity, forward-looking perspectives have enriched our understanding of advisory service, I hope. So also, we truly appreciate the brief yet inspiring introduction to INSEAD. For the attendees who are about to study abroad, so it was especially valuable. So to all our participants, thank you for your engagement and presence. So we hope today's session has sparked new ideas and expanded your thinking on the future of finance. So we look forward to welcome you again in our upcoming sessions and cooperating in the future. Until then, thank you again. So thank you all for being part of today's discussion.
Great. Thank you.